and welcome to At the Coalface. My name is Roy Thompson. I head up MHA Carpenter Box Financial Advisors. Today, I'm joined by Tom Ledger of LGT Vestra. Tom's an investment manager. Tom, I've been emailing out these investment updates over the course of the last few months. A couple of people have come back with some questions. So one question that's come up, which is quite interesting, is around Bitcoin. So Bitcoin has been in the press, well, a huge amount over the course of the last few, probably the last couple of years, really. But prices have been doing seemingly quite well, although very volatile. I guess people are interested in it. It's becoming a little bit more mainstream. At the moment, we don't recommend it to clients because it's unregulated. I don't know if you've got either a personal view or a view from LGT Vestra.
Yeah, absolutely, Roy. I think for starters, it's always worth pointing out that at the moment, and as you've kind of alluded to, the FCA, the regulator, actually are banning people like myself to advise or even on a discretionary basis go into Bitcoin or any token-based cryptocurrency. And the prime reason of that is that the price fluctuations and volatility from their perspective have been far too high at the moment for it to be a viable investment. And there's far too much going on underneath for it to be really valid for a retailing client, particularly from an investment advice perspective. So I think that's where we stand as a business. It's not something we consider in our investment universe. From a personal point of view and looking at the kind of price action historically over the relatively short lifespan we've seen of Bitcoin, 10 to 15 years, it's gone up a lot and then dropped 80% twice. Now, in any asset class, that's extremely volatile, and again, not something which we would necessarily attribute to a kind of worthwhile long-term investment. And we think a lot of the price action to date is much more based on speculation and potentially the future technology of what the underlying blockchain technology might be able to do in the future. But at the moment, it's still very much speculative.
So the underlying technology might be something that would be investable, but as an asset at the moment, certainly not sort of on the agenda, and that's understandable. It's interesting to me that firms like Tesla have taken a position. So for a retail investor, there is looking through a portfolio. I guess there's now starting to get there's a way that people might start be able to access Bitcoin exposure. Do you see other companies going down that sort of route, or do you think Tesla are fairly unique?
At the moment, I think Tesla are quite unique. The actual cost of a transaction in Bitcoin is something like 200 or 300 times that of a kind of Visa or MasterCard transaction. So there's a big headwind there. The likes of Tesla accepting purchases in Bitcoin and in fact, PayPal or another company where you can transact in Bitcoins. You have this transactional cost on top of what you're paying, which at the moment kind of makes it unfeasible and more expensive to actually do the transaction. Obviously, in the future, as more and more companies might take this on, you'd probably see that cost come down. But I'm not sure if you actually look at how the technology works, it would ever really be able to compete with the likes of a MasterCard or a Visa who've really built the business around payment transactions globally.
Yes,
I think another headwind for the technology itself is the environmental impact, and that's something which we're all looking at more closely across our whole range of investments. But the Bitcoin mining, to take that example, is incredibly energy intensive. They place these big. They're called mines, but they're big data centers really running this code and trying to mine these Bitcoins. And they do kind of use the same amount of energy as a kind of a collection of small countries. Just that one mine is enormous. And in terms of anyone who is wanting to maybe reduce the carbon footprint of their investment portfolio is kind of a complete no-go at the moment. It really is shocking when you look into the numbers.
Wow. Yeah, and I guess wouldn't be at the forefront of my mind, sort of the environmental impact of the mining of it, but it's quite interesting. And I guess that might be something that prohibits or slows down the pace at which it sort of becomes more widely accepted in the investment universe.
Yeah, absolutely. Unless they can, and that example itself is specifically focused on Bitcoin and the way that code's written. I think there is arguments in the future for other cryptocurrencies, particularly using that blockchain technology to not be that as intensive, but at the moment they all require computing power to actually release these coins, and that in effect costs energy. And when you kind of look at what it is a virtual asset just created out of a thin air, for want of a better phrase. And do we really need to create that energy consumption for what gain? What gain are we getting for that energy consumption? And that really is the debate at the moment, because it is energy intensive, and I don't think the gain at the moment is really worth that extra kind of environmental impact.
Wow. Yeah. So not in the short term, certainly wouldn't be in investment portfolios. And if someone was specifically looking for exposure, I guess there would be specialist platforms, but that would be something they'd have to go direct. They wouldn't get it through a financial advisor or an investment manager, and that unlikely to change in the short term. I guess away from Bitcoin, notably last week, there were some announcements in the US about potential tax increases. I don't know if you want to talk through sort of what that might look like and the effects that might have in short term, I guess.
Yeah, absolutely. So last week, Biden came out and released some proposed tax changes, and the bulk of this was really taking the taxation on investments above that for high earners than that they are receiving on income. So this hasn't happened in the US in a long time, and actually would mean that if you're a wealthy individual who's paying the highest marginal rate now, and you've also got an investment portfolio, you're going to be paying over 40% on tax, and that's compared to 20% now. So an almost doubling of your taxation on your investment returns.
Wow. Yeah.
I think in terms of how this might impact investments and why it might be a concern for us in the future, at the moment it's too close to call. I think I've discussed this before with yourself, that the Democrats only have a one-seat majority in the houses in the US, and therefore this is likely more of a headline-grabbing tactic from Biden to kind of put his worst, most punitive tax potential changes, but then for them to be watered down as they go through the houses as actually come into law. And that's what we'll be focusing on, is where do these rates settle? I think it potentially might increase short-term volatility a little bit, as maybe people are bringing forward some of those tax crystallizations on those gains. But really, for longer-term investors, we always advise people that taxation is forms one part of your investment strategy. There are many other reasons to invest, and actually to remain invested and not crystallize gains if you don't have to. And so, I think for longer-term investors, this is less of an issue.
Yeah. So there may be a bump in the road to some degree. The size of that bump, I guess, is dependent upon what happens as it moves through into legislation. And Biden's start point, I guess, is the negotiations start high and work back to something that might become sort of acceptable. So something to look out for over the course of the coming months, I guess, and the impact that has on underlying investments.
Yeah, absolutely. It's something which we will keep an eye on, but I don't think anything too concerning at the moment.
Okay. Tom, as always, very well spoken, and really appreciate your time. Thank you very much, Tom Ledger.
You're welcome.